Okay, so we're going to go ahead and get ourselves into chapter 18. As I said, we'll do chapter 17 next time. And notice we're talking about organization and capital structure. So we're going to pretty much be focusing on the formation of the corporation as we have the individual or individuals that are forming the corporation are contributing property to the corporation in exchange for stock, okay, and what the tax consequence is there. Capital structure, I'm not going to say much about because they don't really get too much into any real tax consequence there. Capital structure is really a company trying to decide what is the proper mix between stock and debt when they form the corporation. So we'll really be looking more at the organization. Okay, now we're going to see that the overarching principle here is going to be that the company is going the shareholders that are basically contributing to this corporation, and we'll start out in the formation of it, are going to be contributing capital, usually property in a lot of these questions. And the question comes up, well, do they have to pay tax on that transfer? Because there's essentially going to be a difference between their basis and the fair value at the time of transfer. Well, the tax law looks at that, Congress looks at that and says, well, that's not fair to tax those individuals on that because they don't have the wherewithal to pay. All they have done is given up their property and received stock in exchange for that. Okay, so for that reason, that sort of transaction would not be taxed. Now, there's going to be two sort of major changes that to come up from not having to recognize tax. One is if they receive some sort of cash as part of that transaction, then typically they will have to pay tax on the cash that was received. They'll have to realize the gain on the tax that on the cash that was received, and they will have to pay tax on that. Or if the corporation assumes a liability on behalf of the shareholder, that's equivalent, at least in the eyes of the law, tax law, as receiving cash for that. They consider that boot, and they would have to pay tax on that consequence. Okay, so we're going to be seeing transfers of property. Typically, we don't have to pay tax on that as long as we receive stock in exchange. But if we start receiving some cash, starts kicking in the potential that we'll have to pay some tax on that. Okay. We will also take a quick look at what the basis is to the corporation once they actually receive that property. And the basis to the corporation is typically going to be the basis of the taxpayer of the shareholder that contributed that, and we'll see that towards the end. Okay. All right, guys, make sure you're focusing on your UGBA 121. This really isn't been time to sit there watching, videos from, previous episodes of I Love Lucy or something. Okay. All right. You guys probably don't even know. You guys know what I Love Lucy is? No? It's a TV series that ran for years and years and reruns and was like the the icon of television situation comedies, I guess. It lasted so long because what they did, unlike other TV shows at that time used videotape, and videotape is not as easy to preserve as film. And so what I Love Lucy did that was different is they filmed what they had their different episodes, and film is much easier to preserve. That's why it always looks so much better than other shows that you see where you can barely watch it. You can watch I Love Lucy, and that's why it lasted so long. So don't be watching I Love Lucy at this point. Okay. All right. Okay. So let's go ahead and let's take a look at the basically the sort of the situation here. And we sometimes don't have to recognize gains. And the one that we're really focusing on here is this section 351. Okay, and recognition of a gain or loss is postponed until a substantive change in taxpayer investment occurs. So what happens? We're going to be giving property over to the corporation. Probably we have a sole proprietorship and we're sitting there and saying, hey, we want some sort of limited liability. Maybe we're a barber shop and we're afraid we're going to cut somebody's ear off. And if we do, we're going to be personally liable for that. So we turn around and we form a corporation. We incorporate to protect our personal assets in case there's some sort of issue, that could have a legal consequence to us. So we're going to start contributing property and putting that out of the sole proprietorship and into the corporation, a barber chair, whatever it is, right? Our building, etc. Well, you look at that, and it wouldn't be fair to expect that we would have to pay tax on that because we haven't received any. Our economic consequence hasn't changed at all. We still have a barber chair. We still have a building. We simply now have put it in the shell of a corporation. Okay? And so they're saying that we shouldn't have to pay tax until we do what? Until we actually sell that property, or if we sell the shares of stock later on and get cash for that, then that should be the taxable event, not the putting of those assets into the corporation. Okay, so we're going to see that we're going to have the transfer, and it's going to have to be a controlled corporation, and we say we'll talk about that later. But essentially, when we get that stock, it's going to have to constitute 80% of the ownership of the corporation in order to be considered controlled. And we'll see that that can be made up of one individual, could be made up of a group of individuals if they meet certain requirements. Okay, and so we will not recognize a gain upon the and no loss, by the way, until we transfer the property to the corporation. Upon, I should say, the transfer of the property in the corporation in exchange for stock. So we will not have to pay tax on that event. Okay? Now you come over and you take a look, and we say business is incorporated, and the owner's economic status stays the same. The investment in the business asset carries over to an investment in corporate stocks. So I have At one point I had barber chair, I had building. Now I have I don't have a building, I don't have a barber chair anymore. I have stock in exchange. And so now my ownership is in that stock, and we're going to see that the basis and the property that I gave over typically will carry over as the basis of the stock. Makes sense, right? Because then when I sell that stock, then I can recognize the gain as though it were the property that I held at one time. Now, it has to be the situation when only stock in the corporation is received. The shareholder is hardly in position to pay the tax. And that gets into our, concept way back. Remember when we were young, back at the beginning, wherewithal to pay, okay, that we discussed in chapter 1. You see weird hyphenations. That's typically because I copied something from the textbook and it went down to the second line. So forgive me for some weird hyphenations here. However, the taxpayer, if the taxpayer receives cash or other boot. So cash is sometimes called boot, okay? And then you say, well, then what's other boot? Typically, other boot is if there has been the situation where they have taken over a liability for me. If they've taken over a liability for me, that is also considered boot, okay? If that's the case, then the gain will be recognized, and it's either going to be to the extent of the cash that I've received or the actual gain, and we look to the smaller amount there. Okay, so let's just go ahead and you'll see how that works here in a couple minutes. But let's look at Ron, and he has these different bases in these different items, and then he has the fair value. Now he's going to be giving this cash and this furniture and this land over to the corporation. And so you look, and there's a difference between the fair value and the book value. And one would say, okay, what's his name, Ron? You have to pay the tax on that difference because you have a gain because you have transferred that over to a different entity. You've sold it to that different entity. But what's happening? He's not taking cash. He's taking stock in exchange for that. And so what happens? Ron will receive corporate stock worth 370 in exchange, and without the provisions of 351, somebody would be expecting he should pay tax on that 100,000. But under Section 351, Ron does not have to recognize any gain because his economic status has not really changed. Ron's investment of the asset of his sole proprietorship is now represented by what? Now stock ownership. So he hasn't changed. He still has these assets. He's getting the stock for that. And so he hasn't received any boot, no cash. There was no assumption of any liabilities. And so he does not have to recognize any gain and therefore no tax on this. So you take a look at this other example. Amanda and Calvin form this Quail Corporation. Amanda transfers equipment with an adjusted basis of $30,000. That's her basis. Fair value of $60,000 for 50% of the stock worth $60,000. Calvin transfers equipment with an adjusted basis of $70,000. Fair value of $60,000 for the remaining 50% of the stock. Now you look at our buddy Calvin here, and Calvin's looking and saying, well, wait a minute. He potentially has a loss here, doesn't he? Okay. He does not have to recognize or cannot recognize the loss either because what? Because of the 351. So you section 351 requirements. So you don't have to take you don't have to take the gain. You don't take the gain, you can't take a loss either. So you take a look at the solution. Amanda, the explanation, I guess. Amanda has an unrecognized gain of $30,000. That's the difference between her basis and the fair value of the property, and she will not have to take that until later on she sells the stock. Calvin has an unrecognized loss of $10,000. Both have a substituted basis in the stock. Amanda has a basis of $30,000 in her stock. So when she sells it, let's say she sold it the next day for $60,000, now she's got her $30,000 cash. She pays the tax on it, right? Calvin has a basis of $70,000 in the stock. Assume he sold it the next day, then what? He should only get $60,000 for that. So now he can take that $10,000 loss at that point in time. But the transfer to the corporation did not generate a tax consequence. But now the basis of the stock has the what? The lower, or in this case, the higher old base for Bob, or whatever his name is for Calvin, the what? The higher or the lower basis carries over to the stock, whatever it is. Okay? Okay, good. So let's go ahead and let's take a look at some more discussion here. And an important part, it is mandatory. If a transaction satisfies the requirements that we're going to look at here, you will treat it like this. You say, but I want to pay the tax. Too bad, you can't. We're going to sit there and we're going to what? Make you wait and carry that basis over if you meet these requirements. Okay, and it'll be a little silly for somebody to try to, say that they want to treat that as a tax at that point and overpay their tax. I mean, if you overpay your tax, what happens? You get a refund, and they're just going to generate the refund for you, right? I mean, they're just going to kick it out to you. The government doesn't want to get in the position of being your bank and holding. So they'll look there, and if you have a refund on file, they send you a refund check, whether you ask it for it or not, right? Okay, so it'll come back to you if you overpay the tax, okay? Therefore, if recognition, of course, you have to have had a filed a return, right? So you file the return, because you have the withholding, and if it's overpaid and you don't file a return, they're not going to know if it's overpaid, right? But once you file that return, boom, the system just generates you a check. It's not somebody sits there and says, okay, I owe John a refund, let me write him a check. The IRS system just automatically cuts you out a refund. You say, well, what if they audit it later and find out that, I didn't correct my tax correctly? Well, at that point, they'll send you a bill for an additional amount, right? But the automated portion of that will send you a refund if you pay if you send in a tax liability and you've had withholding or whatever paid taxes in excess. So, okay, so therefore, if recognition of gain or loss is desired, the taxpayer must plan to fail to meet at least one of the three requirements. So if you don't want to treat it like this, don't meet these requirements, okay? But you see the three requirements, which is what? It has to be property is transferred. It's going to have to be things like equipment, that sort of thing. Property has to be transferred in exchange for stock, and what? The property transfers are in control after the exchange, and we're going to see that that's going to be defined as 80%. And you're sitting there and saying, well, wait a minute, didn't Calvin give some cash? Yes, but he also gave what? Property. So property has to be in the mix. It cannot just be a straight up cash transaction in order for it to qualify. Now, if you give cash and somebody else gives property, then we might be okay on that, okay? But somebody, somewhere in the mix, property has to have been exchanged, okay? All right, now you come over and we say, for example, the definition of property. So we're going to go through those three requirements. What is it, guys? Property, stock being exchanged, and what? We have control. Okay, so let's just look at those three aspects as we go through here. Property first. Definition is comprehensive, and it includes what? Plant, equipment, unrealized receivables of a cash basis taxpayer, and they're calling out cash basis there because if you're an accrual basis, we consider that what? A receivable as revenue to you already, so they wouldn't count that as property. But for cash basis, it's not revenue until what? Until we actually collect that cash, so we're going to consider that as property. Okay, patentable invention also qualifies as property. So if you transfer a invention over that is patentable. Now that does not mean that you already have a patent on it, but what? You could be getting a patent on that, and so that would be considered property. Okay, taxpayer must report as income the fair value of any consideration received for compensation of services. So what happens here? I don't know. We're going to do some legal work in exchange for stock that we're putting in. Well, that is a taxable event because what? You have earned that income. And so there will be tax if it's been compensation that has been provided. Okay? And it would be equal to the fair market value of the stock that is received. So that's a little bit different than accounting purposes. Accounting purposes, we look to the more readily determinable value. If the service has a more readily determined value than the value of the stock, then we would use the value of the service. For tax purposes, they're calling out and saying whatever the fair value of the stock, that's the amount that we're going to record the compensation for. Okay, so the basis in the stock in this situation for compensation, therefore, would be what? The fair value of the stock, whatever it was, and that will be the basis of the stock that will carry forward. And if we later on sell that stock, it's going to be the difference between whatever the fair value was at the time we provided the service and whatever we sell it for at that point in time. That later point in time, that could be a gain or a loss. Okay, stock. What is considered stock? Could be common stock, could be preferred stock, most preferred stock. Now, you guys into the whole idea of starting up businesses and stuff? Do you guys study that at all? No? Not too much? Okay, I teach a class for accounting for entrepreneurs, and so they're not accountants, they're entrepreneurs. And so trying to explain accounting to them is like, it took me, I think I told you guys the story, it took me like 2 classes to get them to accept that assets equal liabilities plus stockholders' equity. Okay, so they were like, let's see, maybe it doesn't. Let's think about this. I'm like, no, stop. Okay, so anyway, what happens? There's different levels of stock. You have what they call like Series A stock, Series B, and as you go along, the kind of stock goes up in terms of how it certain the rights that it carries and stuff. And sometimes in that Series A, the investors don't quite trust you yet, and so they want some sort of an attachment to say, hey, if there's some sort of problem with the corporation and I want to get my money back, you have to give me my money back. Well, that is considered what? Even though they're calling it preferred stock, that actually is a liability for the tax purposes, and so that would not be considered stock. Okay, so if a preferred stock is considered non-qualified preferred stock, means it possesses many of the attributes of debt. If you receive debt in exchange for your cash, that is not stock, therefore it would not qualify for the not cash but for your property that you contribute, then it would not qualify as a section what is it, section 351? What is the section? 351. Okay, would not qualify as 351 because what? You've received a long-term debt in exchange for your property, not stock, right? So it has to be what? Has to be stock, and typically common stock most preferred, unless there's some sort of ability for you to get your money back, then they treat that more as debt than as stock. Okay. Control. Okay, what do we have for control? So we've got property, we've got what? We've got definition stock, we've got control. So for the transaction to qualify as non-taxable, the property transfer must be in control of the corporation immediately after the exchange. That is, the person or persons transferring the property must have at least 80% stock ownership in the corporation after the exchange in order for that to qualify. So, more specifically, the property transfers must own stock possessing at least 80% of the total combined voting power of all classes of stock entitled, and 80% of any of the total number of shares of all other classes. So 80% of the voting for sure, and what? And 80% if there's any other type of stock. Okay, so the key rule here is what? 80%. Okay, now notice that they say person or person. So it's a piece of cake. If it's one person, then that one person has to hold 80%. If it's a group that is going to meet certain requirements, then the group together has to meet what? The 80% requirement in order for that to qualify. Okay, so that's what we're saying here. Single person or a group, I don't know, several, I guess, taxpayers, if they are all parties to an integrated transaction. So to satisfy timing requirements, when one or more persons involved, the exchange does not necessarily require simultaneous exchanges by those persons. So you could have what? First person comes in, they're 80%, another person comes in, they put some more in, now they're what? Now they're 10%, the other person is 80, but what? Together they constitute more than 80, they constitute 90, so that would also qualify them as well. Okay. However, you say, well, how long after that? After the first person came in that little example, would the second person have to come in? And they say close together in time, and I did not see anything that called out what a specific amount, what we mean by close together in time. And when you look at some of the questions, you'll see that it's way later that the second person comes in, and they'll make it clear that it was not close together in time, and that's how we'll define. So I don't think we have a clear cutoff as to when we mean what we mean by close together in time. I did not see anything that indicated it called out a specific time. Okay, so let's take a look. Jack Exchange property basis is $60,000, fair value of $100,000 for 70% of the stock of Gray Corporation. Is Jack at 80%? Jack is not in control, right? They consider control 80%. What's control for financial accounting purposes? More than 50%, right? 50.000001 is considered control, and then we would have to start doing consolidation. But stop, John, we're not talking about financial accounting here. This is tax. They called it out as 80%. The other 30% of the stock is owned by Jane, who acquired it several years ago. The fair value of Jack's stock is 100,000 because that's what he's giving up as property. So Jack has to recognize a taxable gain of 40,000. The transfer on the transfer, because he does not have control of the corporation after his transfer, and his transaction cannot be integrated with Jane's because the phrase what? Several years ago. Okay, notice they don't say, hey, it was 10 years ago because the statute says 10 years. They just give us the notion that it was not relatively close in time. Okay. Okay, good. Now, transfer of property and services. What happens here? Well, I could give some property, I could give some service. And you're saying, well, wait a minute now. You said it had to be property that you're giving. And so does the part of the service that you've given completely outweigh everything? And now it's not considered to be a Section 351 because of that? Well, you have to be careful. It's the proportion of how much is service versus property that could trigger the necessity to recognize the gain and not qualify for, because you don't qualify for 351. So let's just take a look at this one. Sarah transfers property of 400,000 with a fair value of $1 million. So we've got a potential gain there of 600,000. Does she have to take that gain and receive stock of 50%? Tiffany receives the other 50%. Are they together going to be in control? 50-50 is what? 100. So they're going to meet the control aspect here. But let's see if they're going to meet the property aspect. Even though this slide is headed control, we're really talking about property here when service is involved. So Sarah has a taxable gain of what? Of 700,000 because she did 600. I don't know where I came up with 700,000. 600,000 because she did what? She rendered services, didn't she? Okay, and because that service constituted too much of what was being contributed here, as a sole transfer of property, she receives only 50% of the stock. So for Sarah to avoid gain recognition in this case, she would need to receive at least 80%. For that service. So because even though the two of them together constituted 100%, because Sarah was giving what? Giving service and not constituting 80%, then she would have to pay the gain on that transfer. Okay, they didn't get to 80% contributing mostly property. Now, you take a look, and a person receiving stock in exchange for services and for property transferred is tacked on the stock value related to those services, but not on the portion for the property. Now, this is when the property the service, I should say, is not constituting as much as we saw in the previous example. So such a person can still be treated as a property transfer. In this case, all stock received by the person transferring both property and services is counted in determining whether the transfer acquired control of the corporation. Now, this is because they're now not just giving this what? Big chunk of service here. They are also providing what? Property as well. Okay, so in the previous example, we should have got Sarah to do what? Contribute some property somewhere in this equation, and if she would have, then that would have allowed us to qualify, use her share to qualify for the control. So let's just take a look here. Assume the same facts as example 11, except that Tiffany transfers property worth $800,000 in addition to the services rendered. Am I saying, did I say Sarah? Get these people mixed up. Sarah wasn't the problem. Who was the problem? Tiffany, because she just gave service. Okay, but now they're switching it and they're saying that what? They're saying that Tiffany also transfers property worth $800,000 in addition to the services which are generated which are rendered to Garden at a value of $200,000. So now she's given what? A good chunk of property that is more than the value of the service. So now Tiffany becomes part of the control group. Sarah and Tiffany now have 100%. Consequently, 351 is applicable to the exchange. As a result, Sarah has no recognized gain because she only gave property. And what? And Tiffany does not recognize a gain on the transfer of the property, but she does have ordinary income in that she has done what? She has contributed at this point in time what? She has contributed some property to the equation, so she would be considered part of the control group. Okay. Okay, good. So don't give too much service, right? If you want the 351 to kick in, but if you give property and service, make sure you're giving up property that would make it a substantial part of the equation. Okay. All right, let's look at a couple of questions from your homework. I haven't put all of them in the slides, so when I say your homework, the quiz, whatever. So I haven't put all of them in here. So if you look at Canvas, you should see the Word file that's sitting there that has additional questions, and I've selected some of them and embedded them into the lecture here. So Mitchell and Powell form Green Corporation. Mitchell transfers property, basis 105,000, fair value is 90, while Powell transferred land, basis 8,000, fair market value of 75, and 15,000 of cash. Each receives 50% of Green Corporation stock for a total value of 180,000. So each got 90,000 worth, right? Okay, of the stock in exchange for what they were giving up. As a result of these transfers, well, first off, have they met the 80%? So they're good with the 80% because they have 50-50 and they both gave property. Now, Mitchell has recognized a loss of 15,000 and Powell must recognize a gain of 67,000. We're looking in what? Should not be any gain, should not be any loss because you can't decide to recognize the gain. Once you've met the requirements, they've given property. They're ending up at what? They're at 100%, and they are ending up. They're given property, and they're ending up in control. So they have to recognize. They don't recognize gains and losses, right? Neither Mitchell nor Powell has any recognized gains or losses. Well, we know that that's the answer, right? Okay, under section 351. Let's look at the other two, though. Mitchell has no recognized loss, but Powell has a recognized gain of 15. Now, they're trying to trick you into thinking, well, wait a minute, there's cash involved. That's boot. Shouldn't there be a gain there? But the boot has to be what? Has to be received, not paid. So that doesn't constitute it. Green Corporation will have a basis in the land of 23,000. Okay, what happens? We exchange the stock for the land, and so what happens? The basis of the stock picks up the what? The basis of the land, and the land is what? Basis is going to carry forward to the corporation, right? So we've really just, we've exchanged stock for the land. So if, what's his name, whoever the guy was that owned the land, who owns the land? Powell decides, hey, you know what? I'm tired of this corporation. I don't want to be involved in this thing anymore. I can't work with you, whatever. So what happens? He walks and he sells his shares of stock to somebody else. He pays the tax, what? Based as though he sold the land. And if the corporation decides they want to sell the land, they pay the tax as though it was Powell that was selling the land, right? And so Powell sells the stock, corporation sells the land, and each go their separate ways, whatever. Okay? And it's obviously not none of the above. Okay. All right, good. Let's take a look at number 2. Jane transfers property, basis of 180,000 and fair value of 500,000 to Green Corporation for 80% of its stock, which is worth $425, and she takes a note of what? 75, right? Because she's got land fair value. She's only getting stock worth $425. She probably wanted a little cash out of this deal, right? If she's going to give up this land that's worth $500,000, and she'll take some stock, okay? And executed by Green Corporation made payable to Jane. Oh, okay. I was looking. Where's the amount of stock? There it is. So they called us 80%, so we've got the control, right? So we've got control, but what's happened? She has given some what? Has received what? Some cash, hasn't she? So that's considered boot. And if that, not cash, but what? A long-term note is still considered boot. It's like cash. It's if it what? Boot is going to be essentially, guys, if we receive cash, we receive what? Some sort of cash equivalent, like a note or something like that. Or we'll see here in a little while, in the next couple slides, frankly, if they have assumed a liability for me. That's like cash. Those are all considered boot, and we have to take a gain for that, and that gain is $75,000. Okay, now we take that gain to $75,000 because what? If Jane had compared the $500,000 to the 180, it is what? That's clearly more than 75,000. So it's the lesser of the cash received or the actual gain, whatever it would be. In this case, the gain is clearly what? Clearly more than the amount of, not cash, but the note that she got. And so that's considered, that's the amount of gain she has to take to 75,000. Okay. All right, good. Let's take a look at number 3 here. Eileen transferred property worth 200,000, basis 190. So we have a potential gain there of what? 10,000, right? Okay, then what? When I read that the first time, I said Goldfish Corporation. It's Goldfinch Corporation. In return, she received 80%. So we've got the control issue of the stock in Goldfinch, and the fair value of the stock is what? Is 180. So what's happening here? She has a difference here of 10,000, but the difference between the property and the fair value of the stock that she got is what? Is 20,000, isn't it? Okay. But what happens? She also gets a long-term note of 20,000. Good. So they compensated her with this long-term note for 20,000, right? Okay. So do we take the 20,000 for the note? Can't take 20,000 for the note because it is more than what? The potential gain. So we go to the lesser of the potential gain or the amount of any boot received. In this case, unlike with Jane, in this one, whatever her name is, Eileen, the amount of the gain, potential gain, was less than the boot received. So we go with the gain of 10,000. Okay. Okay, good. Let's take a look at Ann. She transfers land. And transfers land. We're at 200,000 with a basis of 40. So we got a potential gain there of what? 160 going on. Okay. To Brown Corporation, an existing entity, for 100 shares of its stock. Now, when we look at this, it does not have to be formation of a corporation. It could be an existing entity. But when you come in, you have to have done what? Acquired 80% of the stock at that point in time. You say, well, how the heck would that happen? Well, maybe they have more shares authorized than they've issued. And so there's a bunch of shares that still have not been issued, and you can come in and acquire a big chunk of them in an existing corporation and meet the control requirement of the 80% at that point in time, right? Okay. So we come in and we say entity for 100 shares of its stock. Brown Corporation has 2 shareholders, Bill and Bob, each who own what? Each who own 100 shares. Have we met the control requirements? 100, 100, 100. When Ann comes in, she's only acquiring a what? A third at that point in time. So she has not met the control requirement, right? So as a result, Ann has a basis of 200,000 is the answer here. The basis is what? The value of the land that she gave up. Why are they letting her bring her basis up to this 200,000? If she sells the land tomorrow for 200,000, she has no taxable gain at that point, right? Because her basis is 200,000. But Ann has no recognized gain. That is what? That is not true. She has to recognize the gain for the property now, this $160,000 gain. She has to take that because she didn't meet the control requirement. If you don't meet the control requirement, they make you take the gain at that point in time, don't they? Okay. So if you look at this, you know, what Congress is doing here is helping you to do what? To go into the corporate form of business. That's what they're trying to do, right? They're not trying to set you up so you can go around giving property to all these different corporations and not paying tax on it. They're trying to help you to what? Transfer your assets to a different form of business, and they want you, that's why they want you to have that control after you've transferred them to this different form of business. And she didn't qualify. So she has to pay the gain. She'd have to pay a gain on 160,000 tax on 160,000 gain. Brown Corporation have a basis in the land of 160. No, we exchange bases. I give you what? I have now stock with a basis of 200,000. You've got land with a basis of 200,000. I go and sell my stock tomorrow for $200,000, I presume, no gain. The corporation sells that land for 200,000, no gain. Okay. Then what? Ann has a basis of 40,000. No, because she did not meet what? Did not meet the control requirement, so she doesn't get to keep that 40,000 basis. She had to pay the tax on the 160, and she gets to. I think I misspoke. The corporation's basis, it's not. It's going to be what? It's going to be the 200,000. Brown Corporation has a basis of 200,000. Yeah, because that was her basis. Excuse me, that's fine, because that was her basis, 200,000. Okay. Okay, good. Let's go ahead and let's take a look at assumption of liability. Now, assumption of liability is going to be similar to what we saw if you know, we have cash, essentially. We treat it as though we received cash in the deal. But let's just go ahead and take a look. Without a provision in the contrary, assumption of liability, the transfer of mortgage property to a controlled corporation could trigger a gain to the property transfer if the corporation took over the mortgage. So the corporation is going to pay the mortgage for me. That's like receiving cash. So Section 375 provides that when the acquiring corporation assumes a liability in a Section 351 transaction, the liability is not treated as boot received for gain recognition purposes. Nevertheless, liabilities assumed by the transferee corporation are treated as boot in determining, so we treat them as boot, but in determining what? The basis of the stock received by the shareholder. So we will have to reduce that basis in the stock by whatever the liability is that was assumed by the corporation. So later on, if we go and do what? Sell that stock, then we'll have to pay a gain on that portion that constituted the liability that was assumed by the corporation. Okay, so as a result, the basis of the stock is, as I just said, is reduced by the amount of liability assumed by the corporation. And as a result, we will have to pay tax on that at the time that we actually were to sell that stock. Okay, so there are a couple of exceptions. Okay, exception one is if they are doing this simply to avoid having to pay the tax liability. Okay, so we take a look. Satisfying the bona fide purposes is not difficult if the liabilities are incurred in connection with the transfer of normal course conducting a trade or business. In other words, I'm doing the barbershop and I'm contributing my building to the corporation, and there's a mortgage associated with that. Well, that's pretty easy that we're going to reduce the basis in the stock by the amount of the liability that's happening. But what happens if if the liability, the mortgage or whatever, is taken out shortly before the property is transferred and the proceeds are utilized for a non-business purpose. If that's the case, then they're going to treat that assumption of liability as cash, and you're going to treat it as though it's cash, and you will have to pay the tax on that distribution. Okay, so let's just look at this example with Dan has real estate basis of 140,000, fair value of 190. Now, if he just stopped right there and contributed what? Contributed the real estate, he would not have to pay tax on that gain, assuming, okay, and they're saying it's into a controlled corporation and receives stock in exchange, right? But let's take a look at the little shenanigans, I guess, that Dan engaged in here. However, shortly before the transfer, Dan mortgaged the real estate and uses 20,000 of proceeds to meet his personal obligations. So he took a little money out of that real estate first, didn't he, before he transferred it over? And when he hands over the property, the corporation is going to assume that liability. In this case, the assumption of the mortgage lacks a bona fide business purpose. Consequently, the release of the liability is treated as boot received, and Dan has a taxable gain. And it's not the entire gain, it is just what? The amount of cash that he got out of this. Okay, so he didn't mortgage it. There wasn't a mortgage there for a business purpose. He was just trying to get the money to pay some personal obligations. Now, this one is kind of interesting in that they're not going to play around and sit there and try to say, well, okay, how much of the assumed liability constituted personal use versus bona fide business purposes. If any amount is used for business purposes, it taints the whole thing. I mean, for personal purposes, it taints the whole thing, and the entire amount is treated as a distribution for personal purposes. So you look at this one, and Tim, an accrual basis taxpayer, incorporates his sole proprietorship, trying to get out of, cutting the ear off situation, whatever reason he decides to do that. So among the liabilities transferred to the new corporation are trade accounts payable of $100,000 and a credit card bill of $5,000. Now, the corporation will assume those liabilities, and the assumption of liabilities potentially would do what? Would then reduce the basis in the stock, right? So we won't have to pay tax on that assumption of that liability unless he sells the stock, right? But you come up and it says Tim used the credit card to purchase an anniversary gift for his wife. Well, thanks, Tim. Good move. So what happens as a result? His wife may be happy with him, but as his accountant, we're saying, why'd you do that? Because now what? Under these circumstances, all of the 105,000 liabilities are treated as boot and trigger the recognition of the gain to the extent the gain is realized here. So he'll have to take a gain for any gain that might be involved. Okay, they don't tell us what the difference is between the basis and the fair value of whatever he's contributing, so we can't figure out what the amount of gain is without that information. But he will have to take a gain because on this 105,000 liability will be treated as boot and will trigger the recognition of any gain. Okay. All right, good. Let's take a look at exception 2. Okay, this is what happens when we are going to have assumption of liability. So this second exception provides the amount of shareholders' liability assumed exceeds the total value of the basis of the properties transferred by that shareholder. Okay, the excess is taxable gain. Without this provision, we would have what? We would have a negative basis in the stock, wouldn't we? If we're issuing stock and what? They're taking a liability off our hands that is more than the value of what we've contributed, that would cause the stock to have a negative basis, and that's not going to be acceptable. They don't want us to basically have to get up to a certain amount before we start paying tax on that. And so they would require that we only take the excess is going to be treated as a taxable gain. Okay, so let's just look at Andre transfers land and equipment adjusted basis 350 and 50,000 respectively. So if you add the two together, he's given what, 400,000 worth of stuff, property, right? Okay, respectively to a new corporation for 100%. He's met the control. It's giving property. The corporation assumes a liability on the transferred land of 500,000. Uh-oh, what's happened? He's given what? He's given less than the liability that's assumed by the corporation. Well, that's a gain. That's a gain. I mean, think about that. You owe 500,000 on your house, and the dude says no problem, just give me what, give me 400,000 and you're good to go. That's a gain, isn't it? Okay, and so what happens, he's going to have to pay tax on that gain. Okay, so what'll happen, he has to recognize a gain of 100,000, the 500,000 liability assumed minus the basis of the asset. Okay, and by doing that, what do? Basis of the property is 400,000 plus we recognize what, 500,000 of gain. So now the basis of this, and then there was a liability assumed of 500,000. We subtract the basis of any liabilities assumed off of whatever was contributed plus any gain, and that brings the basis of the stock down to 0. So now if he goes ahead and does what? At some point sells the stock, he will have to pay tax on that gain at that point in time. Okay, so those are the two exceptions where they don't necessarily just go automatic with the liability, assumption of liability reducing the basis. Otherwise, you take any liability that is assumed and you reduce the basis of the stock. Okay, so Section 351 postpones a gain or loss until the transfer shareholder does what? Dispose of the stock, and we've been saying that several times now. The postponement of shareholder gain or loss has a corollary effect on the basis of the stock received by the shareholder and the basis of the property received by the corporation. What the heck is a corollary effect? And that what? The shareholder takes the basis of the stock is basically what the value of the property, the basis of the property was, and the corporation takes what? The shareholder's basis of the property. This procedure assures that any gain or loss postponed under 351 ultimately be recognized when what? When the property slash stock is disposed of what? Corporation slash shareholder at that point in time. So we just wait for that event to happen. Okay. Shareholders' basis for taxpayer transferring property. In Section 351, the stock received in the transaction is given a substituted basis. So the stock's basis becomes what? Not what the fair value was at that time, but whatever the basis of the property was. Essentially, the stock basis then becomes what? The same as the taxpayer's basis in the property had the property transferred, and then will be that amount, however, is increased by any gain that you've recognized. If you do have to recognize some gain because there's been boot paid out or a liability assumed or something like that, because you already paid tax on that gain, and so they just add that to the basis of the stock. Otherwise, you'd be paying twice on that gain. Okay. So you look at this, and this example I kind of debated putting in because I don't know, it gets a little sing-songy, and we've already kind of understood this, but let's just go through it. I mean, I think it's a little redundant from what we've already understood, but Keisha and Ned form Brown Corporation. Keisha transfers land of 30,000, fair value is 70. Ned invests cash of 60. They receive 50 shares in Brown Corporation worth 60,000, but Keisha also gets 10,000, right? Because they're receiving these shares that are worth 60,000. She gave up land that had a fair value of what? of 70, so she gets 10,000 cash out of that. The transfer of the property, the transfers of property, the realized and recognized gain on the transfers are the basis of the Stock and Brown Corporation to Keisha and Ned are as follows. Easy for me to say. So what happens? Keisha has what? She has the basis of the property, $10,000. Fair market value of the stock is 60. She received boot of what? Of 10. So she has a realized gain here of 40,000. That's the what? The difference between the 70 and the basis of 30 on the land. Okay, so she has a realized gain of 40, but she only has to take what? 10 of that, because 10 was the boot that was received the cash, right? And it's the lesser of the cash or the gain, okay, that was realized. And so she takes the 10,000 because that was lesser. Now the basis of the stock is what? Is the basis of the property that she had originally minus what? Minus any gain that she's recognized, which in this case is the same as the boot received, that gain, plus what? Plus they go ahead and add back the gain. So I mean that's sort of a wash, and that it's just her basis because she's already paid tax on that portion of the overall 40,000 gain. She's going to have to pay the tax on the 10,000 cash she got, right? So it comes back to 30,000. Okay, now really, when I think about it now, these two examples are simply showing you what happens if the boot received is less than the gain. Okay, so let's just take a look. I mean, that's really the moral of example 22 and 23. So assume the same facts as 22, except the Keisha basis in the land is 68,000 instead of 30,000. Okay, because the recognized gain cannot exceed the realized gain, the transfer generates only 2,000 of gain to Keisha. So what happens? The basis of the property is 68. The fair market value of the stock is 60. So instead she has what? She has this $8,000 $2,000 gain, which is what? Let me just write that over here. 70,000, or did they put it here? 70,000 minus what? 68. Fair value is 70,000. Her basis is 68. So she has a $2,000 gain here. Okay, but what? She received boot of 10, and you're supposed to take what? The lesser of the realized gain or the boot. But now notice what? Her basis in the stock is 60,000. That's the what? That's the original basis, which was 68, minus what? The amount of boot she's received, but plus what? Plus the amount of gain that she has already recognized because she already paid tax on that portion, and so she gets to add that back to the basis. Okay, so it's the lesser of whichever one, right, that you take is really the moral of this story. Okay. All right. Basis of the property received by the corporation generally is determined under a carryover basis issue. This rule provides that the property basis of the corporation is equal to the basis in the hands of the transferor increased by what? The amount of any gain recognized because the transferor has already paid the tax on that, right? And the corporation does not have to pay the tax on that again. So we add any gain recognized to it. So it's really the basis of whatever the stock is that the stockholder took, that the shareholder took. That's the basis that the corporation gets. They just switch basis. They just exchange one for the other and keep each other's basis. Okay, a corporation's transfer of its stock for property is not a taxable exchange. Okay, a transfer of a share for services is also not a taxable contribution to the corporation. So neither of those events trigger tax. If someone buys the stock for property, that is not, the corporation does not have to pay tax on that. Someone contributes services, the corporation does not have to pay tax on that. They're issuing stock. Issuance of stock is not seen as an income. However, a corporation can deduct as a business expense fair market value of stock it issues in consideration of services. Now, be a little bit careful there, because you see sometimes where they have contributed the service that they've contributed as part of the organization of the corporation, and organization costs are capitalized. They are not expensed. Let me read that to you again. Organization costs are capitalized. They are not expensed. Now, this gets a little bit confusing because under what? Under financial accounting, organization expense costs are expensed, aren't they? Okay, financial accounting, you expense those. And the reason you expense those is that FASB, Financial Accounting Standards Board, looked at that. And what happens to most startups? They collapse, don't they? They go out of business after a year or so. And FASB looked at that and they say, well, we don't want a situation where what? Where you're capitalizing all these organization costs. People look and see this asset and think, wow, this is a viable company. Let me invest my stock. Meanwhile, what? It's a bunch of junk investment that was made, a bunch of money that was spent trying to, develop that at the end of the day crashes and burns. So FASB takes a conservative approach of expensing those. Meanwhile, the tax law is looking at it and saying, well, wait a minute. We don't want people sitting there expensing a bunch of these organization costs, getting some sort of tax benefit from that. Corporation not paying tax now because of all these organization costs, and we lose out on that potential for tax. So different objectives, different treatments, right? Be how you deal with organization costs. So organization costs are capitalized. They are not expensed, okay? So, and that's really getting to this, that if you spend money that is something that is capitalized, then that is not considered a deduction for the corporation. Okay, so let's look at this one. Kevin and Nicole form Indigo Corporation with the following transfers. Inventory from Kevin, basis 360, fair value 400, and improved real estate from Nicole, basis 320, fair value 375. Nicole, an accountant, agrees to contributor services worth $25,000 in organizing Indigo. The corporation stock is distributed equally to Kevin and Nicole. As a result of the transfer, and Indigo can deduct $25,000 of business expenses. No, right? If this was regular financial accounting, yeah, it is expense, but for tax purposes, we don't expense services, the cost of services that are organization costs. They would need to be capitalized, okay? Nicole has a recognized gain of $55,000 on the transfer of the real estate. No, it's what? Property. She does not have to take the gain on that. Indigo has a basis in the inventory of 360. Yes, the what? Corporation does what? Takes over the shareholders' basis, don't they? Okay. D, Indigo has a basis. No, it is 360, and we know it's not none of the above. Okay. All right, good. Let's go ahead and let's take a look at this question. And we have Rick. He's transferring the following assets and liabilities. Okay, so we've got these assets, but we also have this what? This mortgage that's going to be assumed, okay, by the corporation. And so in return, Rick receives $75,000 in cash plus 90% of Warbler Corporation's only class of stock outstanding. Fair market value is $225. Okay, so we want to figure out here in return Rick received, and so they want to say which one of these statements is correct. Okay, so let's just take a look at how they're coming up with the 60,000 gain, and we have fair value of the stock in Warbler is 225, but we have to do what? We have to reduce the basis by what? By this 75,000 cash you received. Then what? We reduce it by any liabilities, and so we come up with what? Not reduce it, but we have to increase the basis, not reduce the basis, increase the basis by that, because we are going to basically increase that basis so that we don't get a less of get more of a gain. We're going to take more of a, what am I trying to say here? He's got cash, 75 of cash and 30,000 liability, so he's going to have to pay tax on those, right? And so we don't want him to pay tax on those twice. So he adds that in, and then we go ahead and we subtract off what? The basis of the property that was transferred, and so he has a realized gain here of this 60,000. Okay. Okay. Question? $270,000 is the 225. Oh, I'm sorry. 270,000 is the 210, the equipment of 45, and the truck of 15. So that's the basis of what he contributed. We don't include the liability there. So he contributed 270, and so we have the fair value of the stock, but we add to that basis, to the basis of the stock, the amount that cash that he received and the liability. And so that difference is a 60,000 gain. Okay. Okay, guys, that's pretty much it for chapter 18. Next time we will do the same thing. I'm going to take a look again at chapter 18. I'm not entirely sure that we need to, kill ourselves with chapter 18 because a lot of it is sole proprietorship versus corporation. I think we know all those things already. So let me take another look at that, see if there's some vital things that I can pull out of that. And if not, I will go to whatever the next chapter on the syllabus is, and we may just skip chapter 18. Okay? All right, guys. I will see you on Wednesday. To Thursday. I always do that. I'll see you on Thursday. Make sure you signed in, please, and return that to me.